Rebecca Patterson joining us right now. She's the former chief investment strategist over at Bridgewater Associates, helping us count you down to the closing bells just about 8.5 minutes ago. And Rebecca, I guess that is the question here, is kind of like, it seems like a lot of people agree on the destination, right? The idea we're going to get rate cuts, the idea that we are going to get some economic softness, but there seems to be a lot of difference in opinion about the degree of that economic softness, the degree of Fed rate cuts, and more importantly, the degree of how the market's going to react to it.
Exactly.
Yeah.
No, I think you summed it up really well, and I also like your turbulence comment. I am you. We're going to have more turbulence. I'm sorry for us. We're going to have our seatbelts on because the market isn't decided on the journey or the bumpiness of this landing. And so every piece of data is going to be soft landing, hard landing debate, and the stock market and the bond market are going to react to those. I don't think we're out of the woods yet on that. You know, today we had the NFIB, the Small Business Sentiment Survey. It was better than expected. And important to me, hiring plans were steady. So they're not, the small businesses, which is the bulk of companies in America, are not looking to lay off workers yet. So that's really good news. That's soft landing news. The PPI today suggests the Fed might be able to start easing quickly. That's soft landing news. But then you have other companies announcing layoffs and you know, consumer confidence data that's not great. And so, you know, we don't know. I think anyone who says they know which kind of landing we have right now is not being very authentic.
And this is a good time for a shameless plug that we'll be interviewing Holly Wade, the executive director over at the NFIB, a little bit later in the program. I am curious, though, about Fed rate cuts. The market is convinced we're going to get something in September. Bloomberg Economics thinks we're going to get 50 basis points and maybe even another 50 before the year is out. Is that going to change things? And I mean, not for the market so much, but for the economy, and more importantly, just for regular people who are out there spending on their credit cards or trying to buy a home or a car or other things on credit. Is that going to matter?
Yeah, I think there's a risk that just like rate hikes were slow to feed through the economy versus what had been expected, rate cuts might be similar. And the main reason I'm saying that is the housing channel, which is the biggest transmission channel for monetary policy. So right now, a 30-year fixed mortgage is about 7%. So off the highs, but still pretty darn high. If you go back the last 15 years or so, the average was under 4%. Now, if I'm one of the many people who locked in something closer to 3.5%, 4%, if I don't have to move, even if the Fed cuts 100 basis points by year end, I'm still getting a lot less house for my money. Housing costs broadly are up, the mortgage is expensive. So I think it's going to take longer for people to feel unlocked till they have that wealth coming through housing.
This is my moment, 2.75%, and I feel okay about that, saying that out loud all the time.
She says this every day. She literally just walks by my desk and whispers in my ear, 2.7.
I mean, it's
and then just
like,
keeps walking.
I don't know. I was really proud of myself. Okay, but to that point, that's on the consumer side, but on the company side, in terms of investing capex, you have that uncertainty. You have the cost of capital maybe not coming down as fast as one might think, and then you have election uncertainty. So the capex cycle that we keep expecting, does that happen?
I think a lot is on hold till after the election because the differences in policy between the Republicans and Democrats, especially on things like taxes, are pretty extreme. So if I'm a CEO and I'm making a 5-year or a 10-year strategic investment, I want to wait as long as I can to get the bang for the buck from lower interest rates if they come, and I want to have more clarity on what kind of tax reality I'm going to be facing. I don't think we're going to know that even on mid-November or early December. I think that's going to be later 2025 before everything starts to get flushed out.
So what's the best allocation within equities and broadly with that scenario?
I mean, given that I think we're kind of on the fence between soft and bumpier landing, I prefer to be somewhat defensive in my allocation right now. I still like large caps. I like U.S. large caps. That's going to include tech still. I like it as a structural longer-term investment. I like having some defensive positions. I know energy's gain hit today. I like energy as a geopolitical hedge and with super attractive valuations. But then outside the U.S., I think the U.K. is interesting, especially domestic stocks. Extremely low valuations. No one owns it. The Bank of England's going to start a rate cutting cycle later this year. But importantly, it is what we call a low beta market. It tends to move less on the downside. It acts more defensively if stocks go down. So if you want some geographical diversification with the U.S. election coming up, I think that might be an interesting place to hide a little bit.
That's an interesting call there. I'm going to look look deeper into that. What about Asia? You find anything attractive over there?
Oof. I mean, the news out of China right now is making my hair poofier than normal. You know, this is an economy that's struggling so hard to get growth, and yet they're intervening because they don't want their bond yields lower. They need low bond yields.
Yeah.
And because they won't let their bond yields lower, consumers are saying, I don't know where to put my money. I can't put it in bonds and stocks, so they're all going into gold.
Yeah.
So gold is another thing I like in this environment. But until China really stabilizes and the consumer there gets going, I'm staying a little bit anxious about Asia, generally speaking, and also Europe, because Europe is much more dependent on China than the U.S. is.
I'm going to squeeze in just one last quick question on gold, because the run-up that we've had here, do you think that has been driven more by concerns about what's going on outside the U.S.?
Yes. I think that most of the run-up we've had over the last year and a half is China. China's central bank diversifying and China consumers desperately looking for somewhere to save and grow their money.